This is Chad Stayskull from Eagle Wealth Management, and I'm here with our educational economic update for January 2019. In this month's video, I'm going to discuss some of the major headlines that influenced markets in December. I also hope to provide some insight into what these developments could mean for you as an investor. So how did we close out 2018? To put it bluntly, December was a challenging, volatile month for stocks, as equities ratcheted between losses and gains. Want an illustration for how dramatic the turbulence was? Consider the Dow's performance on the days surrounding Christmas. First, the Dow experienced the worst Christmas Eve in history. Then, the very next trading day, the day after Christmas, the index posted its largest point gain ever. That experience was pretty much December 2018 in a nutshell. In fact, despite positive returns on the year's final trading day, the Dow and S&P 500 had their worst December results since 1931. All three major domestic indices had their worst annual returns in a decade. In 2018, the S&P 500 lost 6.2%, the Dow declined 5.6%, and the Nasdaq gave back 3.9%. Just a few months prior, the indices were reaching new record highs. So why the about face? Many investors sold stocks off in reaction to worries about economic growth, the Federal Reserve's policies, and ongoing trade tension. However, that answer could oversimplify the situation. Some people blamed computer-generated trading for the intense fluctuations. Others said it was a period of hypersensitivity to headlines. Of course, investors had many headlines to digest, including a government shutdown that was on its 10th day by New Year's Eve. But we want to take a moment to look beyond the biggest headlines and see what the data told us in December. In the latest readings, we learned that personal income was up 4.2% over the same time in 2017. We also learned manufacturing and service sectors both beat expectations. The economy grew at 3.4% annualized rate in the third quarter. That reading was slightly below initial projections, but at the same time, only one quarter had faster growth in the past 4 years. That was the second quarter of 2018. In other words, several data points are showing that beneath the market gyrations, the economy is still strong. Federal Reserve Chairman Powell echoed these sentiments when announcing interest rate increases in December. More concerns might be here, and the market, it might not like more interest rate increases. But the Fed's assessment of our current circumstances indicate a very healthy economy. In the new year ahead, we're going to continue to monitor the market's real risks and their opportunities. One thing that won't sway us, however, are the headlines. Well, that's it for this month's Educational Economic Update. Please remember, nothing we talk about here is a recommendation. If you'd like to discuss your personal situation, please feel free to give us a call at 541-330-0220. We'd be happy to talk with you. Once again, this is Chad Stayskull from Eagle Wealth Management, signing off for the month of January 2019.